I missed you guys. Absolutely, it's good to be back with you. All right, so we're going to spend a little bit of time today talking business. Now, here's the challenge. What I have found in previous semesters is that when we're talking things like income or exemptions, credits, some of that stuff you guys have maybe experienced that before, and so it's a little bit easier to relate to. The challenge with what we're going to cover here in chapters 3 and 4 is some of this is stuff that you haven't seen before, right? Some of this is stuff that maybe if you haven't run a business or been part of doing the taxes for a business, which I'm guessing for a lot of us who probably haven't, this is going to be something kind of new, right? So please ask me questions, but just know that if it was going a little smoother, a little easier before, and this is a little bit harder to pick up, you'll get it, right? Students have done well in the past with this, but it just does take a little bit of extra time to maybe relate to some of these things because you haven't maybe seen it in practice. Now again, I've talked to some of you and gotten a sense that maybe you have worked on a business, so you probably have seen some of these before, but I know for many of us in here that's not kind of the world we come from, and that's totally fine. Let's just start with this, kind of as a general rule. As a general rule, when I have a personal expense, is that something that's deductible? Okay. General rule of thumb is personal expenses are not deductible. Now again, there's some that you'll see on Schedule A that we can deduct, right? General rule of thumb is it's not. What would you say the general rule of thumb is when it comes to a business expense? It is deductible. Okay, so whether that feels fair or right, just kind of want you to be aware that that's the way that the rules are set up. Okay, so a lot of those, again, if I pay my KCP&L bill, right, for my house, not deductible. If I had a rental or if I had a business that I was paying KCP&L for that business building, same company that I'm writing the same check to, right, but it's business versus personal, we're going to find that it's not deductible for my house, right, but it would be deductible for the business. Okay, so again, just one example. We're going to find there'll be a lot of those as we go through this here. So let's jump in. All right, very important. You're going to see this on your test. Okay, this idea of making sure that you know how to define a deduction. Okay, so there's kind of some key terms that I want you to be familiar with as we go through this. When it comes to a business, I've thrown that term out there, and you guys have probably heard that, I'm sure, many times, right? But kind of the way the code defines it, well, it's not very good, quite frankly, the way the code defines it, right? What we're looking at, though, is this idea of am I engaged in an activity for profit, right? Am I doing this with the motive of actually making money, okay? We're going to find that we're going to get to a little later on this chapter this idea of a hobby. So if I just do something because it's fun and I lose a bunch of money at it year after year, right, we're going to find that the IRS treats that differently than if it's a business and this is my living, this is my livelihood, right? So if you think about it, if this is my only business, right, if I'm not doing anything else, or if I've done this for the last 10 years and I've got some expertise, right, those are some things that are an indication of this is a business engaged for profit. Now again, I just worked with this year a buddy who just bought a business in October, so he's only had it open about 6 months at this point, right? He lost money his first year, his first 3 months, actually, right, because we did taxes through the end of the year. Is that pretty common with a business that you start? Yeah, super common, right? So the idea is not that you have to make money and you have to make money the first year. And again, that's the goal, right, of a business. But I think a lot of us can probably understand that when you start a business, it's not uncommon, right, to lose money that first year or even that second year. Business that I'm working a little bit with as far as my mother-in-law, she started a franchise down in Florida. I think I've shared maybe a little bit of that story with you, right? We projected a loss the first year, right? I mean, just going into it, we were expecting she was going to lose money that first year. Okay, and you're like, why the heck would you do that? Because you hope year 2, year 3, year 4 it gets a little better, right? That's kind of the idea there. But the point is it's a business, and we took business expenses that she's clearly actively engaged in that business for a profit. So let's talk through kind of some of the components that we need to have for a deduction. Okay, so again, some of this is going to sound pretty straightforward, pretty common, pretty easy to understand, maybe is the word I'm looking for. Okay, but I want you to kind of know the pieces to what makes a deduction. Okay, so let's talk through this idea of ordinary and necessary. Okay, so if I think about ordinary and necessary, so give me a business. Somebody help me out here. We're going to kind of use an example, but I'm not very creative, so I need you guys to help me. So what do you guys think? What are we going to do? What's our business here?
Yogurt.
Yogurt. Okay, so we are a yogurt business. Okay, so what are some expenses you think that might be ordinary for a yogurt business?
Buying yogurt.
Okay, yogurt.
Or ingredients.
Okay, the ingredients. Okay. Okay, and we'll find that when we sell that yogurt, we're going to find that that's when we get an expense there. Okay, cost of goods sold maybe. All right.
The pricing of it.
The pricing. Okay, so when we sell the yogurt, we're going to find that we've got some sales and we've got some revenue there. Okay, what about from the expense side, the deduction side? What are some deductions that we might have for that yogurt business?
Rental of your facility.
Machines. Okay, so depreciation. Okay.
Rental of the facility.
Okay, for sure. Rent, right? We're going to have some rent. Okay. Would you expect a yacht? Or would you expect golf memberships? Probably not, right? Those are things that maybe don't fit a ton with a yogurt business. Does that make sense? Whereas those might make a lot of sense in a different business, right? But for a yogurt business, I wouldn't expect those to be ordinary and necessary expenses, okay? As far as legitimate business purpose, right? So we're kind of getting at the same issues here, right? But again, the question comes down to, right? Does that expense that you're incurring, does that make sense for the business that you're in, right? So again, we talked about the rent, right? But the question is, do I need to rent a 50,000 square foot space for my yogurt? Does that have business purpose when I find out that I'm doing, I don't know, something illegal, let's say, in the other 48,000 square feet, right? I'm making stuff up here. Clearly, you can tell us why I should make these up ahead of time, okay? But the point is, you have to think through, right? Is there business purpose for those expenses, okay? And then the last one, this is kind of interesting, right? So let's say for my yogurt business, I do some marketing, right? And I take, I don't know how this is going to work. Maybe I'm trying to, the folks that provide me the yogurt, okay, I'm taking them out to, taking them out to dinners, let's say, to try and, work on that relationship, let's say, okay? But let's say I make yogurt sales for the year of $100,000 and my meals are $250,000. You're like, well, that doesn't make any sense, right? So this idea of, okay, I could understand maybe, $100, $500, maybe something like that for meals. That seems reasonable in light of the revenue that's being generated by that relationship, right? So the tough thing with tax you've probably found is that not everything is a cut and dry, clear answer, right? But there's clearly some things that we can kind of very quickly say that doesn't make sense, right? If I've got a client that's generating $20,000 in revenue, I shouldn't be doing $50,000 in expenses, right, to try and wine and dine that client. That wouldn't seem to make sense. Okay. So do we kind of have an idea of, again, different businesses are going to have different expenses that are going to be considered ordinary and necessary, right, for that business. Now again, necessary doesn't have to mean there's no way that I can survive if I don't have this whatever, right? But we are looking at, is it something that would make sense for your particular business, right? Is it something that others in your industry, right, have this particular item, this particular expense that you're incurring, okay? And again, unfortunately, there's times where this gets into the courts, right? And the courts have to decide, hey, is this something that we would consider ordinary and reasonable, ordinary and necessary, for a particular business. So, all right, but that's what we're looking for. Again, does it pass your sniff test? Okay. So a couple of you saw this when it came to volunteering, right? This idea of Schedule C. So what we're looking at is for a business. Again, if I get a W-2, we said that we're an employee, right? Does that sound familiar? If I am my own boss, if there is no employer, if I'm the employer, if you will, right? If I'm the one that's running the business, making the decisions, okay, I'm considered self-employed is the general rule there, right? And the idea is with that business, if it is formed where there's a single owner, we're going to use Schedule C. So some of you probably have heard of an LLC. Does that sound familiar? Limited liability company. Okay. If I'm the only owner of that LLC, guess what? I can file on Schedule C. But as soon as Yang and I become partners, guess what we need to do now? What do we need to do first?
Partnership.
We have a partnership, right? So now we have partnerships. We got to file a tax return for the partnership. Okay. But if I have one owner for that business, right, I can file a Schedule C. Again, I'm not overly concerned that you all know when is it a Schedule C versus a Schedule C EZ. And the idea for that really is if I'm doing this from a tax preparation perspective, software is going to generate the correct form based on the situation for that taxpayer. But just if you're curious as far as when do we use Schedule C, when do we use that EZ form, we're looking at things like, does the business have inventory? Or did the business have a loss for the year? Or did the business have $5,000 or more in expenses? So those would all be things that would trigger using Schedule C. Okay, so most of the time, I'll be honest, you're using Schedule C. Okay, but if it's a really small business, you might find that you can fit it on that one-page Schedule C EZ form. Okay. There's a number of things that cause you to end up needing to use the bigger form. Yeah, not a big deal, again, from a preparation perspective. Software handles the difference there. So let me do this. I think this would be probably a good time for me to walk through some things on the Schedule C. Okay. Your book went into this, and I thought this was a good thing to just to bring up. This idea of, from an audit perspective, this can be pretty heavily audited. Okay, this idea of a business that has a Schedule C. And we're going to find that a lot of times there's maybe some overly aggressive positions that a taxpayer might take when it comes to a Schedule C. Think about it this way, right? If I'm an employee and I get a W-2, it's really hard to lie and say, I know my W-2 says 80,000, but I don't like 80,000, so I'm going to skip a zero and just call it 8. I mean, I can do that. That can be my first offer to the IRS, but they'll very quickly say, we reject your first offer, and we've helped you out to file a different tax return, right? But when it comes to Schedule C, right, the idea is there's not a whole lot of stuff that the IRS has to match some of those expenses that you're claiming, okay? And I'm not saying that to suggest that you just make up whatever numbers you want to. That's not what I'm suggesting, right? But the point is, because it has been abused in the past, it does tend to be something that is more heavily audited. And I say all that to say, if you have support and records for the expenses that you're incurring, then I wouldn't worry about it, right? So it's not something that I don't lose sleep at night. I've filled these out for clients and for businesses I've worked on. I don't lose sleep at night. I just know that we've got support for the expenses that we're incurring, okay? All right, so some things to be aware of, right? So if, for example, I've got this business set up as an LLC. That LLC generally is going to have, an EIN, Employer Identification Number, that you've gotten from the IRS. Okay, so the idea is part of the paperwork of getting that LLC set up is to reach out to the IRS and say, hey, we need this Employer Identification Number. For a small business that you form, let's say that that isn't an LLC, you can just use a Social Security number of the taxpayer, and that's fine. Okay. As far as that code, the idea is with that, so there's a ton of different 6-digit codes. This idea being you kind of want to tell the IRS what kind of a business it is that you're reporting income and expenses for. And the IRS uses that to get a sense for, based on the business that you're in, does it make sense the kind of expenses that you have, right? So to the extent that it doesn't, that gives them a good indication of where to spend their time, auditing. Anybody heard of those terms, cash and accrual? Mm-hmm. What do we know about cash basis of accounting? When is it income under cash basis?
When you receive the
Yeah,
cash.
you get the money, right? So as individuals, we think about our tax return. Guess what? We're cash basis, right? So we get a deduction when we've paid something. We record it as income when we receive it, okay? For a business, you'll find that you've got some options. Small businesses generally can choose cash basis of accounting, okay? And again, for a lot of folks, that seems to make the most sense to them when they do their record keeping, is think about it on a cash basis. What's the story with accrual? When do I record revenue under the accrual basis? Do you remember? What's kind of that magic word? Okay, services rendered, right? So we kind of use the term when it's been earned, okay? Versus when I get the cash, right? We said that's income under the cash basis, okay? I will tell you, just be aware in general, even if I'm going to use the cash basis, okay, as far as recording an expense, let's say when I pay it, be aware that when it comes to inventory, I don't get that deduction for inventory until when, do you think? What do I need to do?
Until you sell it?
Sell it, yeah. Okay, so be aware that just the purchasing of inventory, that doesn't give me the deduction. It's when I actually sell it that I get the benefit of recording that as, again, what we call cost of goods sold there. Okay, so that's not familiar. Again, those of you that have had some accounting classes, again, some of us I know in our first semester, maybe we've just gotten the cost of goods sold in Accounting 1. But, okay, perfect. Materially participate. We're going to get to that later on this semester, but here's that. This is a magic box. I mean, it's just magical, okay? So this buddy who just started this business lost $15,000 his first 3 months, okay? So kind of a rough, again, he had a lot of one-time expenses that he's not going to have going forward, so I think he's not losing too much sleep over that. Okay, but this idea of materially participated, we'll talk about this in a future chapter a little more, but the idea is this, right? If I'm actively involved in this business, if I'm spending a fair amount of time as opposed to just simply giving somebody my money and letting them operate the business, okay, I get the benefit of that loss being something that I can use to offset other types of income, okay? So we consider that active income versus passive income. So the idea is his wife was working. He was working very hard but losing money in this business, right? So his loss could be used to offset some of the wages that his wife was earning. Okay, so overall, it worked out well for them as far as getting a little bit of a refund. Okay, but again, that was a magic box, because had we not checked the material that participated, he wouldn't have been able to use any of that loss to offset the income. Okay, just real fast, I'm not going to read through all these expenses, but some things that you'll commonly see in a small business. Okay, so we're going to get to depreciation in Chapter 7. I know you're really excited. We'll get to that in a little bit. I will tell you, for a business, that is one of the biggest, best deductions from a tax perspective. Okay, this idea of being able to buy a piece of equipment, let's say, and write it all off that first year from a tax deduction perspective, legally. Okay, and I'll explain that when we get to Chapter 7. Some different ways that you can do that. Okay, as far as some common things, so we're going to get to, excuse me, meals and entertainment today. Anybody know anything about deductibility of meals and entertainment? We'll get to this in a little bit, but anybody familiar with? Think there's some rules surrounding that? Think it's been abused? There should be. Okay. Yes, there are. The good news is there are. So we'll find out that there are some limitations there. You probably have heard kind of talking about keeping track of mileage, right, for your business. Okay. So under that car and truck expenses, we'll find that we can keep track of mileage and get a deduction based on that. Office in the home, we've heard of that deduction. We'll talk about that today. Right, this idea of if you've got an office that you're using exclusively for your business in your home, we're going to find that you can take a deduction on Schedule C for that too. Okay, so a ton of different things that, I mean, again, think about this, all right? So insurance. In general, can we deduct insurance personally? Okay, we can't, right? But again, it's up there as a deduction for for a Schedule C. Meals and entertainment. Clearly, when I go to the Royals game, okay, I don't deduct that if it's personal, okay? But if I'm taking a client to the Royals game, now I've got a deduction. Sitting in the same seats, watching the same game, right? But there's a different treatment if it's for business purposes, okay? Now, what we're going to find is there's definitely times that folks abuse this, right? You've probably heard this idea of, I go on a 2-week trip to Hawaii, I talk business with somebody for 10 minutes and decide I'm going to write off the whole trip. And I would not suggest that you do that. Okay, and we'll talk about some rules tonight as far as what you can deduct, what you can't deduct. Okay, but yeah, that would definitely not be something I would recommend. Okay, questions so far on kind of what you're seeing on the Schedule C? Again, we're going to unpack a number of these different things, but obviously it's helpful to kind of see where we're going. Perfect. All right, let's keep moving here. Okay, I'm not going to ask him if he's a professional gambler. I don't want to give you guys too hard a time. All right, so general rule of thumb, you're not going to see gambling winnings on Schedule C. Okay, if I were a professional gambler, that's where it would go. But generally, you'll see that as other income on page 1 of your tax return. Okay, here's the bummer. Okay, if I have gambling winnings, I've got to report those. Right, that's other income. If I have gambling losses, bummer number 1 is it's up to gambling winnings. So we've kind of probably heard that before, right? Bummer number 2 is it's Schedule A. Okay, so when is it really a bummer if I don't itemize? Right? If I don't itemize, I had to pick up the income, but I got no benefit for the gambling losses. Okay? I think that's probably something we've seen that before. All right, let's talk self-employment tax. So if I file that Schedule C, if there is no other boss besides me, let's say, right? We're talking in general, somebody that's self-employed. So again, another indication, you'll see somebody that's got a 1099 miscellaneous, right? I think some of you that were doing some volunteering saw those as part of your VITA stuff. Understand if you've got more than $400 in earnings, right, self-employment earnings, you do have to file an additional form. Again, obviously software takes care of the form piece, but the bummer is this, not the form. Who cares about the form, right? The bummer is I got to pay Social Security, Medicare twice. Okay, so again, next time you go into your employer, give them a big hug, say thank you, right, because they're matching, right? So you're paying Social Security and Medicare, and they're matching that. So every time that you pay in the Social Security system, the employer is matching it. Every time you pay in the Medicare system, the employer is matching that. If I'm self-employed, there's nobody to hug but myself, right? I mean, there's nobody else paying into that system. What now?
You have to add twice.
Yeah, so you got to pay it twice, for sure. You do, okay? So that's obviously one of the major bummers about being self-employed. Right, that you're paying Social Security and Medicare twice, so it works out to be an extra 7.65%. So again, let me kind of walk you through these numbers here, right? If you look at your paycheck, so that 12.4, you're going to see you're paying 6.2. Okay, well 6.2 doubled is 12.4. Okay, And if you look at the, if you calculate what you're paying as far as Medicare, I'm guessing you're going to see 1.45%, right? Well, again, 1.45 doubled is that 2.9. Okay. There is some good news. I hope some of us are experiencing this or experience this in the future. As your earnings go up, you eventually stop paying into the Social Security system. Okay. Now, again, I wouldn't memorize that 118.5. Right. That's going to change next year. It'll be bigger. Okay. But good news is, as income goes up, at least one tax that would go down, right, would be the Social Security tax. Okay, so you only pay up to wages of that 118.5. Now again, that could change. Right? There's certainly been politicians that have suggested getting rid of that cap, or really significantly increasing that cap. But as of right now, that's how that works. Okay. Anybody have any thoughts why you can deduct half the self-employment tax on page 1 as a deduction for AGI? What do you think? What's the reason for that? It's kind of weird too. That's half. Why is it half? What are you deducting?
Expense?
Okay, so you're deducting the expense, right? The self-employment tax that you've paid. But why? What do you guys think?
Employees are paying only half to begin with.
Okay.
The employer's paying the other half.
Yeah, so the employer half, guess what? If you looked at the employer's tax return, for those of us that are employees, right, you look at the employer tax return, they're deducting the half that they're paying, right, to match. So the idea is if I'm self-employed, I get the same benefit of that deduction like an employer would. Okay. So, but again, it's just for the employer piece, so it's just for half of the self-employment tax that's being paid. Some of you guys experience this through volunteering, right? This idea of somebody that comes in, didn't pay in estimated taxes throughout the year, right? And the big thing that kicked their butt is this, okay? It wasn't federal income tax in most cases, right? It was Social Security and Medicare times 2, okay? Again, if I'm self-employed, I've got to be responsible, right, for paying in estimated taxes every quarter, okay? Another option is if I'm self-employed but I've got a spouse that is employed, they're an employee, right? One way you can manage that is just to have the spouse take more tax out of their paycheck, right? That's another way of managing that issue if one spouse is self-employed, okay? But you want to make sure that you're not just paying in for federal income tax but also for that Social Security piece. So a good rule of thumb is about 30%, right? So if I make money as self-employed, maybe set aside about 30% for taxes. And again, that changes, right? So if I've got more income, the higher my income, the higher the percentage. But as a good kind of rule of thumb that I'll tell folks, plan on setting aside 30% for taxes. Okay. All right, we'll get to this as far as that bottom bullet. You guys probably can't see that very well, but that 0.9% Medicare surtax. So there is an additional amount that you pay as your income gets higher. Again, I think it's $450,000 if I remember correctly. But point is, that's for high income taxpayers. We'll get to that more later on this semester. So, all right, perfect. So COGS, cost of goods sold. Okay, so for a lot of businesses, right, especially a business where I'm buying and then reselling inventory, or maybe I'm creating a product and then reselling it for more, here's the good news, right? So if I'm Target and I sell you this water bottle for $10, right, I include sales or revenue of $10, okay, but let's say this thing cost me $7. Okay, so the idea is I'm only going to be paying tax on the 10 minus the 7, right, minus what it cost me originally to buy this thing, okay? So what we're going to find when we look at Schedule C is that one of the calculations that you end up doing here, right, is to figure out your cost of goods sold, okay? So this is something that sometimes some small businesses have trouble with this, have trouble coming up with the records for the inventory piece, okay? But really the thing to consider, okay, is what did I start the year with as far as inventory, okay? What did I purchase in additional inventory? And again, if you've had Accounting 1, some of this should sound very familiar, right? I just went over this like yesterday, I think, with my Accounting 1 students, okay? So beginning inventory plus purchases, right? Collectively, again, cost of labor, materials, right? Those are things that you're going to find if I'm making the product, physically making the product, right? If it's inventory that I'm simply purchasing, you're going to find that you won't have that cost of labor piece, okay? Once I've got that, 2 options, right? Either I sold it or I didn't. So if I can figure out what's still sitting on the shelf, what's still left at the end of the year, whatever is left over is cost of goods sold. Okay, now again, understand that cost of goods sold most likely represents stuff that was actually sold, but what else does cost of goods sold include then? Stuff that what? Was stolen? Right, let's be honest, shrinkage, right? So one piece of that cost of goods sold number is shrinkage or stuff that was spoiled or damaged. So that all gets kind of encompassed and captured in that cost of goods sold number. And again, most of it for a business is going to be stuff that was actually sold, but just know that it could also include stuff that was taken or damaged. Okay, so cool. All right, so something important I want to make sure that we understand here is this idea of FIFO and LIFO. We heard of that? Some of us have probably seen that Accounting 1. Okay. Prices are going up, let's say, and normally they are, right, for businesses. So if I'm buying inventory and then replacing it throughout the year, generally, if anything, I'm going to be paying a little bit more for inventory as time goes on as opposed to less. Okay. So LIFO, anybody remember what that stands for? Okay, so last in, first out. So LIFO says I'm selling the new stuff. Okay. So why do you think I would maybe want to use LIFO for tax purposes?
Higher cost of goods sold.
Okay. So if I'm selling the expensive stuff, cost of goods sold is higher. If cost of goods sold is higher, what happens? Income is lower. And why would I want income to be gone for tax purposes? So I pay less in tax, right? Does that make sense? So there's definitely a motivation from a tax perspective to consider using LIFO when prices are going up. And there's nothing wrong or illegal about that, but here's the thing that I need you to understand, right? If I use LIFO for tax purposes, guess what I also have to do? Use it for financial accounting purposes. I can't play the game. I can't say, hey, shareholders, look how great I am, FIFO, right? Hey, IRS, I did really bad, okay? I can't do that, right? I have to be clear in using FIFO for both or LIFO for both. Does that make sense? Okay, so I'm okay using LIFO for tax purposes. I just need to be consistent in what I do for financial accounting purposes. Okay? All right, perfect. All right, we're going to do a little in-class here in just a minute, so we've just got a couple more concepts I want to talk through with you here first. Okay, when it comes to transportation, all right, so we're going to deal with this as far as travel, but we're also going to deal with transportation kind of like within the metro, right? So for example, when I was working at Ernst & Young, right, I would work at Ernst & Young during the day and then I would drive here and teach a class at night. Now again, my commuting to and from Ernst & Young, we're going to find that commuting in general is not deductible. Okay, but when I was going from first job to second job, we're going to find that that's something that is a deductible expense, something that I can include in my tax return as a deduction. Now here's the thing I want you to be aware of, right? I was an employee here. I'm still an employee here, I think, right? Okay, I hope, right, for sure. I was an employee at Ernst & Young, right? So the idea is that expense, that deduction, was something that I would include on Schedule A. It'd be itemized, okay? If I was self-employed, so let's say they treated me as self-employed here, right? That would be something that I would report as a deduction on Schedule C. So we just want to be careful that first we want to figure out, is it deductible? And then we also need to figure out where is it deductible, right? Because we're going to find that a lot of times it's a better answer if I can put it on Schedule C. But if I'm an employee, we're going to find that those expenses would not be reported on Schedule C. Yeah, go ahead.
So if you worked at Ernst & Young and you had to visit a client or
Okay.
go to a client in Topeka, could you deduct that distance as well?
I could. I absolutely could. Now here's the takeaway. So Uncle Ernie was good to me, and if I had those expenses, I would get reimbursed. So the takeaway there is because I got reimbursed, the good news is it wasn't income to me. The bad news was I didn't get any deduction for it, right? So Ernst & Young was taking the deduction there. But let's say I had to go to a client in Topeka, and I didn't get reimbursed, and yeah, that would be mileage that I could deduct. Again, because I'm an employee, it'd be Schedule A. Now the bummer is if it's on Schedule A, you may know why that's kind of a bummer. One, I maybe don't itemize, but what's the other piece though? It's a miscellaneous deduction, so it's subject to 2% of AGI. So the bummer there, I'll be honest, yes, I could deduct it when I was going from Ernst & Young to JCCC, but I wasn't getting any benefit. Right? I was one of those that wasn't going to get me over 2% of AGI, so I didn't mess with it. So yes, it was a deduction, but it was a deduction that did me no good, right, when you have that 2% of AGI hurdle, which is why having it on Schedule C, where you don't have to mess with that, is a good thing. So, okay, so I've got a little chart here that I think I always refer to. This is from an old book a few years ago, but to me it just really helps to kind of explain this. All right, I'm a visual person. Maybe this is helpful for you too. Okay, so going from our house to our regular jobs, again, we call that commuting, right? That's really essentially what that is. Okay, that is not deductible. Now here's the beautiful thing: if my primary place of business is my house, guess what just happened? Anytime I go anywhere, deductible, right? Does that make sense? If my primary place of business is my home, all of that travel becomes something that's deductible. Okay. I mentioned this in terms of regular job to second job. Okay, that's something that's going to be deductible. Okay. So like in your example, Gabrielle, where I was going to Topeka instead of downtown, right? That would have been deductible. Okay. My other location was downtown Kansas City, right? So the fact that I had a temporary location where I was going to Topeka, that mileage would have been something that would have been deductible. And again, same issue where it would have been as an employee, so I've got that 2% of AGI issue. Okay. All right. Does that kind of help explain as far as when it's going to be deductible, when it isn't, right? So part of this comes down to where is your primary place of business. Okay. So again, if you're operating out of your home, then all this is going to end up being deductible because your regular job, your regular place of business is your house, let's say. Okay. All right. Perfect. Let's see what else we got here. Okay. So let's say, for example, I'm commuting, but I'm also, as part of that, I've got a trailer that I'm hauling, or I've got a bunch of tools that I had to bring with me. Those costs related to the trailer or the hauling or the tools, that would be deductible even if it's from my house to my regular job. Okay, now again, obviously if I'm self-employed, clearly those costs are going to be deductible on Schedule C. If I'm an employee, the question there is, did you get reimbursed? I always have to ask that question, right? Because it's one of those where, oh, I spent all this money, and then you find out, well, they got reimbursed for 90% of it or whatever, right? So you want to make sure that you're not including as a deduction the piece that was reimbursed. Okay. All right. Do not memorize this, okay? Because it's 54 cents now, 2016. Okay. It changed. Anybody know why it went down? You have any thoughts? Gas, right? Yeah, for sure. Right. So the price of gas, it's crazy, right? It's gone down. Not complaining certainly. Okay. But yeah, they adjust. Generally, it's every year that mileage adjusts. Actually, there's been times where it's been twice a year. Okay. But the point is, I just want to make sure we kind of understand this, right? There's two ways that you can figure out that transportation deduction. Okay. The one that I prefer, I think it's quite frankly a lot easier and a lot of times, most of the time, gives you a better answer. Is going to be just that mileage. So you keep track of business miles, right? So you keep track of those miles where you're traveling for business purposes away from your primary place of business. Okay. And the beautiful thing there is I figure out at the end of the year how many miles I traveled, multiply that by the 57.5 cents to determine under that standard mileage method, right, what your deduction is. Again, there's another way you can do it, and there's nothing wrong with it, and sometimes it does give you a better answer. Okay. But that's where I got to keep track of all the gas for the year, okay? All the repairs for the year, all the taxes that I paid, let's say, on the vehicle, all the interest that was paid on the vehicle, all the costs associated with upkeeping that vehicle. So that's one issue, okay? The other piece is I got to figure out how many miles were business. I still got to keep track of miles, okay? How many miles were personal? Now again, if it's a vehicle that's all business, this becomes a pretty simple a math equation, right? But for a lot of folks, they're using their vehicle partly for business and partly for personal. Okay, so once I figure out my total expenses, I multiply it by a percentage that I used for business, right? And that would be, actually, and there's another big piece of this, depreciation, right? And we'll talk about calculating depreciation here in Chapter 7. But just know that's a big deduction that you'll get using actual, okay? So here's the bummer though, right? So let's say I decide year one I'm going to use actual expenses, okay? I can't switch to standard in year two, okay? So I may end up getting this big, nice deduction year one, but over the life, okay, it may, very likely will not end up being a bigger deduction, okay? So that's one issue, and two, the fact that it's just a pain in the butt, right, to figure out all of your expenses. And again, if you keep track of it, and if you had a year where you had a lot of repairs, maybe that's going to make some sense, okay? But in a lot of cases, keeping track of, or just using mileage tends to be a better answer and certainly easier to calculate. So, okay, I'm off my soapbox there. Either way, actual or standard, you do get to deduct the tolls. Let's see, so parking tolls. So the idea with that is if I had parking costs and they were for business, right, I don't need to allocate that. I don't need to figure out a percentage. I can just simply deduct those under either method. Okay. Obviously, to take that standard mileage, I need to own it or lease the vehicle. We'll talk about in Chapter 7, but as far as depreciation, so there's what's called accelerated depreciation. It's kind of a default, meaning more depreciation up front, less at the end. Again, if I've taken that depreciation, accelerated depreciation in the past, I can't take the standard mileage method. Okay, so those are kind of the big things to keep in mind there. All right. And I mentioned this already, right? So this idea is for actual expenses. So keep track of all your expenses and figure out what percentage of your miles were business miles, and that's the percentage of the expenses that you're able to deduct. Okay. Schedule C is where you're going to see that deduction to the extent that it's for business. If you were an employee and had some transportation costs that were not reimbursed, again, you report that on Schedule A, but again, understand as an employee expense, subject to what? 2% of AGI, okay? So, which is why, again, I appreciate when, a taxpayer comes in and they're an employee and they've got all these miles. I feel really bad telling them, sorry, right? A, you're not itemizing, or B, you're not going to get over 2% of AGI. So, again, nothing wrong with keeping track of it. It's just, and again, if you're working with a taxpayer, sometimes it's better to just put it in there and show them, right? Instead of trying to explain and say, here's where we put it in, here's the zero, right? That zero means you got no benefit for it, really sorry. But sometimes it just kind of helps to visually see that. Okay, we're ready to do a little in class here. So I want you working on Jafar and Jaclose. I think it's number 2 on the, there you go, yep. So if you could do a quick calculation as far as standard versus actual, look at those 2 methods for calculating transportation. And we'll take a couple minutes to look at that, and then we will reconvene. So feel free to work together. Let's talk through this, see how you did. So remember, there's two methods here, okay? And I don't know about you, but I'm going to go with the bigger of the two. Does that work? Okay. Especially that first year, we have that flexibility of taking either method. So that's what we're going to do is calculate for this guy here, for Jafar. I have some fun with this. Hopefully you guys enjoy these. All right, so takeaway, right? For starters, I want to think about actual expenses. Okay, so if my math is correct there, 11,787. Does that look about right? Mm-hmm. Okay. Now here's the challenge with this, right? If this vehicle was used exclusively for business, okay, this would be a big part of my deduction. Again, I'd add the 450 in parking and tolls, right? But that would be the full deduction under that actual method. The takeaway here, where we have to read into this a little bit, right? His total expense for all miles was at 11,787. Again, personal miles, do we get the benefit of deducting those? I wish, right? I wouldn't suggest you do that, okay? So it's the business miles, right? And only the business miles that we get the benefit of deducting. So the piece that we've got to consider here is what percentage of those miles were business. So again, if my math is correct, I got 80%. Does that look about right? You wouldn't expect given those funky numbers, but it worked out, okay? So 80% is business. So all that to say, using that actual method, we're going to find 11,787, those expenses that we figured out, times 80% plus the $450 in tolls. Now again, we don't have to allocate or use a percentage for the business parking and tolls, and the reason for that is we know this was for business purposes that we encountered these parking costs, these toll costs, that kind of stuff. Okay. All right, so that's actual. Issues, concerns, questions with that approach. So this is one way of doing it. Okay. You good? We could rock this out in a test, 2 weeks? Easy peasy? Okay. All right. So the other method, again, the one that generally is going to give you a better answer, and quite frankly is a lot of it easier to calculate. All right. Business miles times whatever the mileage deduction is for that current year, which for right now, for 2015, I should say. I'm always at least a year behind. Okay. I had somebody that wanted me to do his 2011 tax return. I was like, I gotta really dust off some cobwebs here, but we can look at that. 57.5 cents a mile for 2015. So that works out to be 11,161.90. My math is correct, plus the 415 tolls. So your total is 11,611.90 cents. Okay. So which one do I want to choose there? The bigger standard. Okay. And again, what that means is going forward, I'm able to continue to use that standard method, or if for some reason I want to switch, okay, I am able to switch to the actual method. Okay, but again, you can't switch from the actual costs back to standard. Okay. All right. Now you do need to be aware if I switch from the standard costs, the standard method again where I'm using that mileage times number of business miles, if I switch to actual, understand I do have to use straight line depreciation at that point. I can't use accelerated depreciation. Okay. But you are able to, so again, if I got a lot of repairs for a vehicle, it might make sense at that point to switch. Okay, cool. Very good, very good. Let's keep moving. Any concerns, questions? Does that make some sense? Okay, perfect. All right, so as it relates to travel expenses, again, we've got that same rule of thumb as far as ordinary necessary. So again, you get back to business purpose, you get back to what's the reason for this travel. So again, this is where my 2-week trip to Hawaii, where I do business for 10 minutes, okay? We're abusing that, clearly, okay? So the question is this primarily for business, primarily for personal? And we're gonna find that if it's primarily for personal, then the expenses I incurred for that 10 minutes I was doing business, cool, I can deduct those, okay? So I talked to Bill, we had a cup of coffee, so I can deduct the cup of coffee. Okay, but the $1,000 that I spent on the flight to get over there, probably not a good idea to deduct those travel costs. Okay, all right. Here's the takeaway as it relates to, and Gene thinks this makes sense, and I would agree. This idea related to meals, okay, or entertainment, we'll also find is the same way. We're limited to a 50% deduction. So if I spend, $50 on a meal, only 25 of it's going to be deductible, or 50% of it. Okay, so same thing holds true for entertainment. Okay. The good news is, if I, for example, when I was traveling with Ernst & Young, I would get reimbursed for meals that I had while I was traveling. That wasn't income to me, which is good. Obviously, I didn't get any deduction for it there either, right, because I was reimbursed for those meals. As far as lodging, taxi, laundry, tips, that's all going to be deductible at 100%. Okay, so there's no limitation for that. It's just simply meals. And then we'll also find entertainment is also going to be subject to that 50% limitation. Okay. All right, lavish. Again, that's where the courts have lots of fun defining what lavish looks like. Substantiate, just simply, you got to have some support, right? So this idea of there's got to be some support for your expenses. So again, that can be receipts. Quite frankly, even just simply a record on bank statement is sufficient in a lot of cases as well. So, okay. So as far as this idea of travel, so we've looked at kind of travel within a metro area, let's say, right? But let's say that I, go spend, a day or two working in St. Louis, okay, or Chicago or some other metro area, okay? It doesn't have to be 24 hours, but there has to be a period of rest, okay? Our need for rest, relief, I guess, is the term that they're using here, okay? So if, for example, I, drove over to St. Louis, after work tonight, and then tomorrow all day I worked and then drove home, let's say, okay? So the idea is those travel costs, again, that would include costs to get there, right? So it could be airfare, they could be, I always found it funny, partners at EY, they would fly to St. Louis, okay? And it was like, man, by the time you get in by the time you get to the airport, right, get on the plane, go get your rental car, get where you're going, I'm pretty sure you could have driven there, right, and been, whatever, I don't know. So that's okay. It's another story, another day, right? But the idea is obviously the flight or the cost to get there would be deductible. Same thing with the hotel, right? So the lodging costs are going to be because again there was that period of relief or rest. You'd be able to deduct those travel or the lodging costs. Okay. Now again, it becomes a bit of an issue. So let's say, for example, I had this. At EY where there was someone that was reassigned to Hawaii. It was terrible. They were just very sad, right? I'm joking, clearly, okay? But the point is this was like a 3 or 4 year project, okay? So again, you've got a lot of travel costs now, going from Kansas City. I think they still had family that was here, so they were traveling, back and forth a fair amount. Okay. The point is, this idea is I have a tax home, right, and I'm traveling away from that tax home. Well, the IRS says, hey, if you're traveling for a temporary assignment, it's like 2 years, 3 years, really more than a year is what they're looking at, right? Your tax home has changed. Okay, so again, if I'm going to Hawaii for a week for work or a month for work, my tax home still is here in Kansas City, and so those travel costs are deductible. But you see what I'm saying, where if I'm working now for a year, 2 years somewhere, okay, my tax home has now changed to that place where I'm working. Okay, so then those travel costs end up not being deductible. Okay, all right, very good. Any questions as far as that goes?
I had one about your example of talking to me for 10 minutes in Hawaii. Suppose you talked to me for 1% of the time that you were in Hawaii. Could you have deducted 1% of your airfare?
So the issue, and we'll get into that, but the issue is, was I going primarily for business, or was I going primarily for personal? And I would argue, if I was 1% of the time talking to you, it'd be really hard to argue primarily business.
Okay.
Right? So again, it's not a time issue, but certainly at 1%, I think that'd be a really hard argument to the IRS to say, oh yeah, I talked to him for an hour of my week that I was there, or something crazy like that. And make an argument that was, again, now what we could find is maybe a portion of it. Maybe we can deduct a portion of it.
That's what I was asking. If you talked to me for 1% of the time you were there, could you deduct 1% of your airfare?
You're going to find when it comes to going somewhere outside the U.S., I can do some allocation.
Mm-hmm.
But general rule of thumb when it comes to in the U.S., if it's what we're looking at is, am I primarily going for business purposes? And if the answer is yes, it's deductible. If I'm primarily going for personal, it's just the expenses surrounding whatever the business activity was that I was doing.
Gotcha.
So, yeah. So I agree. There's clearly some gray there. But yeah, I would argue with your 1%. That is hard to make an argument that the primary reason that I spent the week in Hawaii was the hour that I spent talking to you. So, yep. Good question though. Okay. All right. Okay, we kind of were getting to this, right? So I want to talk through this outside the U.S. piece, okay? So the good news is this, right? So the good news when it comes to traveling outside the U.S., we mentioned this idea of you may have to split it, okay? But the good news is there's some times where I don't have to split it. Okay, so again, obviously think about traveling outside the U.S. Those costs can be very expensive, right? I mean, super expensive to, fly, 2,000, 3,000 miles, let's say. Okay, so I had when I was first starting Ernst & Young, I had an intern. This was actually during my internship, right? Another intern who went to Europe. She didn't have a passport, but there was a trip 2 weeks later that that was coming up, and they managed to get her a passport in 2 weeks, which I was blown away by that. I clearly had some connections, right? But this idea of, so she had this 2-week trip that she spent in Europe. Now she worked a lot, with just some really cool experiences. Again, she didn't cover any of those costs, so there's nothing that was something she would be able to deduct. But let's assume that she did. Okay, let's assume she had to pay for her flight, which would be weird, but let's just go with that, okay, for this example here, right? The idea is she didn't have really any control over what they were doing. Okay, she was an intern, right? She was 20-something, I don't know. She was very early on in her career, right? Had no control over what they were doing during this trip as far as where they were going, when, who they were working on, that kind of stuff, okay? So the idea is this. Even if, let's say, half the trip, okay, was personal, we're going to find that because she didn't have substantial control over the arrangements of the trip, if she had costs that were not reimbursed, she was able to deduct those travel costs, 100%, okay, because she didn't have substantial control, right? Let's say you were outside the U.S. and it was, for a week, or it was less than a week, right? That'd be another example of being able to deduct those travel costs, even if a portion of the trip was personal, okay? And then the last one, this is the one I really like, okay? So let's say I'm out 2 weeks, okay? Beautiful thing is, so if I'm gone 2 weeks, okay, or 3 weeks, something, extended period of time, I can play on the weekends, okay? This idea of I can, if I work on Friday, play, Saturday, Sunday, and go back to work on Monday, those days in between aren't considered personal days, right? And so this idea of I can then, as long as less than 25% of it was on personal, I can deduct 100% of the travel costs. Okay, so the idea there is, for a 2-week, let's do the math here, make it simple. So if it's a 20-day trip, right, 25% of that is 5 days. So I can have 5 days of playtime, okay, and still be able to deduct 100% of the travel costs, okay. And the good news is, like, if all I'm doing is playing on the weekends, personal stuff on the weekends, none of it is considered personal, okay. But as soon as I take off a Friday, Saturday, Sunday, guess what? Now I have 3 play days, right? Three personal days. Okay, so you just want to be careful, kind of how you manage that. Okay, so that is traveling outside the U.S. Again, we're talking about the travel costs, transportation costs associated with that travel. All right, let's see if we understand this. So we got Tim travels from Idaho to New Mexico. Okay, $300 and $380 for airfare. $330 for lodging, $150 for meals. That was the business portion of the trip. Okay, and then he's got some personal expenses: rental car, meals, lodging, that kind of stuff. So what do you think? Again, we're assuming here primarily business. The reason for going for this trip was business. So what do you think are the things that are going to be deductible from a business perspective? So the airfare, what do you think?
Yeah.
Airfare?
Airfare,
Yeah.
we're good there. Okay. Lodging, can we deduct that?
Yeah.
Yeah.
Okay, so we're good with that as far as the $330. What about the meals?
75.
Okay, so 75 or 50%, right? So we can deduct 50% of the meals as far as the business portion. What about the personal expenses, the rental car, lodging, meals down below there? Any of that deductible?
No.
Okay. So we kind of see the distinction there. So again, this is a trip in the U.S. Again, the idea is primarily business is what we're going to assume here, right? Even though there's some personal expenses, again, those pieces we carve out and we don't deduct that. Okay? What do you think? Does that make sense? Okay. All right. So you may have worked somewhere where you just kind of get a per diem. You get an amount per day for things like lodging or things like meals related to where it is that you're going. And the idea is, Phil, if you're going to New York City, right, a little bit higher per diem, okay, than if you're going to Overland Park, Kansas. Nothing against Overland Park, Kansas, just clearly lower costs than something like a New York City. Okay, so the idea is there's a website, again, that GSA website, where you can look up and see for a particular zip code or particular address, right, what the per diem amounts are for lodging and what they are for meals. So I took the liberty of doing that for good old Overland Park. I'm sure you're dying to know what those came out to. So for right now, where we're at, we're looking at $112 for lodging and $64 for the day for meals, entertainment. Meals, incidental. That's what that is, not entertainment. The idea is this. Okay, the reason for this is it can be a pain in the butt as a business to keep track of, all the expense reports, right, for meals, for lodging, that kind of stuff. It's just administratively can be difficult. So the idea is this is a way of saying, okay, we had an employee that traveled. This is the amount that we reimburse them. So this is a way that the IRS can use this for substantiation, right? So for supporting these expenses if you use that per diem. Okay, so again, the idea is if I'm wanting to use amounts that are going to be higher than this, or if I've got expenses that are higher than this, I really probably need to have the actual receipts as opposed to using this per diem. Okay, so this is one approach, right? Another approach, which is even simpler, because again, this one requires that you do have to look and figure out for each location that you're going. Again, if I've got employees that are traveling all over the place, this might be a little bit cumbersome to try and figure out for each location. Okay, what's their reimbursement amount? Another way that's even simpler is that high-low method, where it's just simply if you're in New York City, okay, you're going to get the $259 for lodging and meals. If you're in most places other than a few high cost areas, you're going to get that low of $172. Okay, so again, that's an even easier way of saying, okay, based on where you travel, we're going to use that for our reimbursement. Again, there's not a need for a ton of record keeping if you take this approach. If you're self-employed, just know that you do have to keep track of your lodging, but you can use this for purposes of your meals. Okay, so again, there's high-low, again, New York City being at $66, most locations being at 41 for the day. Okay, so again, these are just simply ways of taking that deduction, reimbursing employees, let's say, not requiring a ton of record keeping. Again, takes time to do that, right? Again, most businesses, I shouldn't say most, Ernst & Young, quite frankly, they wanted to see our lodging. They wanted us to scan in our lodging so they could kind of, I think some of it was making sure what was on the bill, right, for lodging. Did we have a whole bunch of food or a whole bunch of other, drinking, well, whatever, that kind of stuff, right? Just want to know, what were the expenses for, okay? So they wanted to see the receipts. Some other businesses, again, use this per diem and are not requiring the receipts. They're still entitled to the deduction based on the, these per diem amounts. So, okay. I mentioned meals. Entertainment is also subject to that 50% limitation. Just know that when it comes to entertainment, there's got to be some business purpose in terms of I'm taking out a client or I'm taking out a prospective customer, or I've got a supplier that I'm wanting to take to a Royals game or go golfing with or take out to a concert, those kind of things. But understand, again, I don't have to be, at the concert talking business, right? That's okay. But before or after, I do have to have some business discussion, right? There has to be this idea of associated with, again, before or after, there has to be some business purpose and business discussion that justifies that expense, okay? So that's the thing to make sure that you're looking for there. Understand if the IRS were to challenge that expense, those are the kinds of things they're going to be looking for. Who was the entertainment or the meal with? What was the business purpose for that, that get together? How much did you spend? On what day did you spend? Again, obviously, if I'm keeping track of receipts for some of this stuff, that's where you can pretty quickly figure that out. Or again, a lot of businesses have kind of an internal system that they've developed where to get reimbursed, you need to put some of that information in there so that they can support it or provide support to the IRS if need be. Real fast, let me just share a quick story. This is kind of fun. So one of the last projects I worked on at Ernst & Young before I left was a business that they had, gosh, I'm trying to think, what was it? It was millions of dollars a year of meals and entertainment that were getting limited to 50%. And the idea was they would, so again, think about kind of the accounting you've had so far. They would have different accounts, right? So that chart of accounts, they'd have, a 6-digit account number. They'd say, okay, this 6-digit account number, anything that's in that account, we're going to limit to 50%. Well, the reality was they were dumping a whole bunch of things in there, travel costs, and maybe things that were not subject to that 50% limitation, okay? So we were able, for that business, there was 3 years they were open under what we're going to call statute of limitations, meaning you could go back and adjust. And the IRS had also audited them for 3 years prior to that. So those years were technically open as well under statute of limitations, meaning we could go back for 6 years and make some adjustments to their meals and entertainment deduction. Okay. The cool thing, because you're thinking, man, this is a large business, so it's like, do I really want to sift through? I mean, what would have been millions of expense reports? And that sounds miserable. Can we all agree that that would be like the worst job ever if that's what I had to go do to try and figure out what stuff did they classify incorrectly? Okay. So what you're able to do is some statistical sampling, where you're going to say, we're going to look at our entire population, right, of expense reports, okay, things that were included in that, in that meals and entertainment deduction, and we're going to pull out, I think we pulled out like 300 or 400 of those that we were going to look at and make sure, did they correctly classify it as limited to 50%, or was there some way that we could, maybe it was travel or something that wasn't, or there was, there's some different exceptions to when you can deduct 100%, and we don't need to worry about that right now. But all that to say, it was going to be millions of dollars of benefits just based on looking at those 400 sample items. Now here's the challenge though, right? So we had, we'll get to this here in a sec, we had a golf shirt was one of the things that was thrown into this account that shouldn't have been. Okay, well the golf shirt was given to a client as a gift. We're going to find that gifts are limited to 25 bucks. Well, this is like a $100 golf shirt that they gave to the client, right? And they're only able to deduct $25. Well, the problem was changing that from, being deductible at 50% to now only $25 deduction made like a $400,000 or $500,000 difference in because you extrapolate it out, right? You see what I'm saying? Where you're taking just that small population and you're now applying it to, millions of expense reports. So every time we made a change, we're seeing like these huge differences in the deduction, right? So what basically, this is the piece I didn't get to experience, which I was really bummed. You get in a room with the IRS agent and you fight, right, over all 400 of these expenses, because you know that each one is going to have a huge swing in the overall, deduction for the taxpayer. So, but we were projecting in the millions as far as savings for them, which the cool thing is you get compensated, right, based on the amount that you're able to help them to save. So yeah, it was a good project, fun project, and it's kind of a cool way of seeing how you can take, again, there were people at Ernst & Young that their specialty, what they did was meals entertainment. I mean, that was it. That was what they learned. That was what they focused on. They got very good at. Were compensated obviously very well for that. But yeah, so they had some fun interactions with folks from the IRS. So, all right, I'll move on here. Okay, here's the tough thing with education. So we've obviously talked about, you've maybe experienced this idea of tuition fees deduction or some of the education credits. So we're going to kind of take a different spin, a different approach here, and we're going to look at this from the perspective of somebody that's already in a career and incurs some education costs. Okay, so things like kind of keeping up my current role, maybe some training to just kind of keep my skills sharp. What we're looking at here is education costs where I'm not able to do a new profession after I finish that school, right? So again, a lot of us in here finishing the accounting associates, and the idea is, after you finish that, you're going to be able to do a new career, right? Something that you weren't able to do before. After you have that degree, you're now able to do or enter a new profession. So what we're looking at really are expenses just to continue in our current role. Okay, so to give you an example, some things have changed in the education world in terms of, to be a professor here, you now need to have a certain number of credit hours in your discipline. Again, don't worry, I have them. You're in good hands, okay? But the idea is there's some folks that, the rules were different 10 years ago, 20 years ago, right? And so they're going to potentially need to go take some more classes. Well, those classes are to keep them in their current role, right? They're in their role now. To maintain that current role, they have some things that they need to do to keep that role. And so that would be an example of kind of what we're talking about. Again, and then those, in that example, those folks are employees. So again, that'd be something on Schedule A. But if I was self-employed and had to continue to do some things to maintain my current skill set, that would be something I could deduct on Schedule C. So for example, I'm going to go in May to a conference out in Colorado. And again, I'm reimbursed for those costs. But let's say I was self-employed, okay, and let's say that I was doing those to maintain my current accounting skills, right? Well, again, the travel costs, right, the cost of the conference, the cost of the rental car, right, the cost of meals at 50%, right, those would all be things that would be deductible, again, because of the education was to maintain my current skill set. Does that kind of make sense where we're headed there? Again, if that conference or that class allowed, or that degree that I obtained maybe helped me to obtain a new, be qualified for a new trade, new business, now we've got a situation where that's not going to be deductible. Again, understand the tricky thing here is it's not deductible on Schedule C, but are we seeing how it could be an education credit? It could be tuition fees deduction. So there's other ways where I could take those expenses and get some benefit for it. It just simply wouldn't be what we're talking about here as far as a self-employed Schedule C education deduction. That's where I'm trying to go here. All right, we're going to look at this. We're going to take a quick break. I know we're a little past our time here, and then we'll pick this back up. All right, so we got Hugh, who's a paralegal, going to law school at night. Let's start with that first example. What do you think? Educational expenses for Hugh as a paralegal going to law school. Is that going to be deductible?
No.
Okay, so it's not going to be deductible under the stuff that we've talked about for this, I would agree, for this particular chapter, right? Now again, could there be an education credit, tuition fees deduction? Okay, that might be something that applies, okay? But the idea is going to law school, Hugh's now able to do a different profession, right? So paralegal versus law school, again, that law school is going to help Hugh to be eligible to be a lawyer, right? A different profession than paralegal. Okay, notice the difference here for the second one, right? Flew to, from El Paso to a conference in Dallas to maintain his current skill set as a paralegal. Do you see how there's a distinction, how there's a difference between those two? Okay, so that second one, do you think those costs are deductible? Yeah, and again, as an employee, it'd be deductible on Schedule A. If he was self-employed, it would be a Schedule C deduction. Okay, cool. All right, let's take a quick break. So again, we'll come back 10-ish minutes from now, 10, 15 minutes. Let this marinate, and we'll finish up chapter 3.